Hi, good morning. This lecture is on equity portion in CFA level 1. So basically, this is based on the CFA official curriculum, which I feel is a resource which is often not used by many candidates because it is lengthy, because it has so much of information. So what I have done is I have actually picked the important concepts or examples, illustrations, which will help you to understand the concept in a shorter time frame, in a better way, because it has to be presented in the correct way, and also it will help you to gain confidence and motivation to more motivation to clear the exam successfully. So these are some of the important things which candidates tend to miss because of their busy schedules, because they're being overwhelmed by the vast content, the depth. So all these things are can be major challenges uh, for an average exam taker or even above average. So the CFA exam is not a beginner level exam. It is highly advanced, and the charter holders expected to show a lot of expertise in how they can evaluate situations, how they can do their problems also. Problem preparation is a very important thing. So this particular service which I'm doing is basically to improve your chances of passing the examination and also learn the techniques which are required at workplace, because only people who have worked in the industry for several years, who have the capability to go to deeper points and have clarity of understanding can succeed or can be able to motivate others. So these are interlinked factors which are which are part of the CFA exam. That is why most people find it difficult to pass the exam. And please don't try to memorize the formulae or the concepts too much, because memory creates an illusion of preparedness, whereas learning really makes the real long-term difference. So let us go to the investment policy statement. This is a part of the portfolio management. So let us see like a case study, because the exam contains many case studies, especially in level 2 and level 3, but in level 1 as well. Mary Gascon continues to discuss their investment requirements with her financial advisor. The advisor begins to draft the constraints section of the IPS. Okay, the constraint section. And Gascon expects that she'll continue to work for the oil company and that her relatively high income will continue for the foreseeable future. So she sees no liquidity problem from income in the foreseeable future. Gaskin and her husband plan to have no additional children, but expect that the son will go to university at age 18. So no additional children, so no additional expenses to be provided for kids, but college education starts at age 18. We don't know what is the current age of the son, not mentioned. They expect that their son's education costs can be met out of their salary income. So their liquidity is good. From salary income, it is savings for the college education is not needed. Gascon's emergency reserve, 100,000 euros, considered to be sufficient as a reserve for unforeseen expenditures and emergency. Again, liquidity is adequate. Her retirement savings of 900,000 euro has been contributed to her defined contribution pension plan account to fund her retirement. Under French regulation, pension fund contributions are paid from gross income, is prior to tax, and pension fund returns are exempt from tax-free. But pension payments from a fund to retirees are taxed as income to the retiree. So until you retire, according to the French regulation, there is no tax expense for the fund contributions or for the fund gains returns. But when you retire, the payment received from the pension is taxable. With respect to Gascon's retirement savings portfolio, which is 900,000 euro, address the following. As concerns liquidity, a maximum 50% portfolio should be invested in liquid assets. The portfolio should be invested entirely in liquid assets because of high spending needs, which is not the case, and liquidity is adequate. The portfolio has no need for liquidity because there are no short-term spending requirements. So the correct answer is C, because there are no short-term, because they don't plan to have kids and the salary income is expected to continue in the foreseeable future. Next question. The investment time horizon is closest to 5, 20, 40 years. Now, most likely the kid, maybe going to college, maybe in 10 years. So answer is B. 20 years is the most likely of the three options given. We don't know the son's age, but the most likely could be B. As concerns taxation, the portfolio should emphasize capital gains because income is taxable, should emphasize income because capital gains are taxable, is tax exempt, and thus indifference between income and capital gains. So as per the French law, pension fund contributions and returns are tax exempt. So the answer is C. The principle of legal and regulatory factors applying to the portfolio are US securities law, European banking laws, French pension fund regulations. So answer is C, which is obvious. As concerns unique needs, the portfolio should have a high weighing in oil and other commodity stocks. We invested only in responsible and sustainable investments, not have significant exposure to oil and other commodity stocks. As Gaskin is working in the oil industry, she should not have high exposure to oil and other commodity stocks because that increases the risk. If suppose she loses her job, then because of the poor outlook for oil sector, then the oil stocks also are expected to go down in value. So that increases the risk. So she should avoid investing in oil and other commodity sectors. Now let us see what is this framing bias. These are behavioral biases, which is again in a very important thing in real world investing for investors as well as advisors and portfolio managers. There are several biases, and this is covered very nicely in the CFA curriculum. And it's very important to understand not only to pass the exam, but also in your own investments or when advising your client. These are very important, and this is not factored properly by most people. Now, what is framing bias? That is one of the biases. Framing bias is an information processing bias in which a person answers a question differently based on the way it is asked or framed. So the same thing, if you tell in a different way, the response from the second person can be 180 degrees, 180 degrees opposite or different. If a person says yes, if you ask in one way, he may say no to the same thing if you put it in a different way, and vice versa. So let us see a good example. Decision-making frames are quite prevalent in the context of investor behavior. So this is a very important thing. Risk tolerance questionnaires can demonstrate how framing bias may occur in practice and how FMPs should be aware of its effects. Financial market participants. Suppose an investor is to take a risk tolerance questionnaire for the purpose of determining which risk category she is in. The risk category will determine asset allocations and appropriate types of investments. The following information is provided to each questionnaire taker. This is an example. Over a 10-year period, portfolio ABC has averaged an annual return of 10%, an annual standard deviation of 16%. Assuming a normal return distribution in a given year, there is a 67% probability that the return will fall within one standard deviation of the mean, and 95% probably for two standard deviation, 99.7% for three standard deviation. Thus, there is 67% chance return can be mean plus 1 sigma, mean minus 1 sigma. So ABC is 10 plus 16, that is 26, 10 minus 16 minus 6. 10 plus 2 into 16, that is 42 and minus 22. And 10 plus 3 sigma. So these are the returns. This is the normal distribution, return distribution, normal distribution returns probability. So 99.7%, almost 100% return will be between minus 38 and 58%. The following two questions focus on hypothetical portfolio A, B, C, D, E, F, and X, Y, Z. The risk and return for each portfolio are the same in each of the two questions, question 1, question 2, but the presentation of information differs. That is where the framing bias comes in picture. Based on the following chart, which investment portfolio fits your risk tolerance and desire for long-term return? Now, they are put in question 1 in one way, which is portfolio 95% probable, that is plus or minus 2 sigma, 10-year average return. Okay, return is shown and the range of outcomes is shown. Second one is portfolio 10-year average return is same, but is shown in terms of standard deviation. Now you look, an investor may choose different when asked question 1 compared to question 2. That is the framing bias. For example, if you look at question 1, it looks like an investor is most likely to choose XYZ because there is no risk of negative return and 0.5% to 6.5%. And average return is 3.5%. So most likely because of the negative losses or the negative returns in DEF and ABC, he may choose XYZ. But if you put the same thing in this format where you don't show the probability range, that is a normal distribution range, and you just say standard deviation 3.5%, standard deviation 1.5, 6%, 12%, standard deviation 10%, 16%. He may choose DEF or ABC because he thinks 3.5% is too low, but he doesn't factor this because he's not aware about the normal distribution returns, okay, distribution returns. So he will choose probably DEF or ABC. So this is a good example of framing bias. Okay, now let us do another thing, example, which is on behavioral biases. There are other types, but these questions are important from an examination perspective. Tiffany Jordan is a hedge fund manager with a history of outstanding performance. For the past 10 years, Jordan's fund has used an equity market neutral strategy. So that is beta is equal to 0. That is a long short strategy so that it is neutral with respect to the market performance, okay, or volatility, which has proved effective as a result of Jordan's hard work. So she has done it for the past 10 years, this strategy. Jordan's reputation has grown over the years as a fund has consistently beaten its benchmark. Employee turnover on a team has been high, so employees are leaving Jordan because the reason is Jordan tends to be quick to blame and rarely gives credit to team members for success. So She doesn't give credit to team members, and she is quick to blame. During the past 12 months, her fund has been significantly underperforming its benchmark. Okay. One of Jordan's junior analysts, Jeremy Tang, is concerned about the underperformance and notes the following. Observation one: certain positions are significantly underwater, means deep losses, have very high risk profiles, and have been held for much longer than normal. Okay, so after she invested, they have gone into deep in the red and they have riskier profiles, but she is hanging on to them. That is observation one. Second one is the fund's trading volume has decreased by more than 40% during the past year. So she is not changing, she's not doing much trading despite the underperformance. That is the point to remember over the past 1 year. The portfolio is more concentrated in a few sectors than in the past. So there is concentration risk also. Worried that the portfolio may be in violation of the fund's investment policy statement, Tang brings his concern to Jordan's attention during a regular weekly team meeting. Jordan dismisses Tang's analysis and tells the team they have to worry because she knows what she is doing. Jordan indicates that because she believes the pricing misalignment will correct itself, the portfolio will be unable to take advantage of reversion to the mean if she were to sell certain losing positions. So she thinks that they would recover due to mean reversion. She reassured the team that this strategy has performed well in the past. So, and the markets will reverse, bringing the funds returns back to normal levels. Tang tactfully suggests that the team review the fund's IPS together, and Jordan interrupts him and reminds the team that she has memorized the IPS by heart. So that is actually a sign of overconfidence. Tang contemplates his next step. He is concerned that Jordan is displaying behavioral biases that are affecting the fund's performance. So it is an example of where an experienced and a successful fund manager also is showing behavioral biases. This is very true in the real world. This is what makes even experienced professionals make very big mistakes. So behavioral biases are an important aspect of investing. By taking credit for successes but assigning blame for failures, Jordan is most likely demonstrating. Okay, is it loss aversion, self-attribution bias, illusion of control bias? So it is self-attribution bias. People take credit for successes and assign responsibilities for failure to others. Next one, which of Tang's observations is least likely to be the consequence of Jordan demonstrating loss aversion basis? So loss aversion bias, sorry, not basis, means holding on to losing stocks in this context for a long period of time. Observation one is it confirms with loss aversion bias because positions are losing their higher risk profiles and they have been still held, whether it is long or short, which is a long short fund, either ways. So that is correct. Second, the fund's trading volume has decreased by more than 40% during the past year. The portfolio is more concentrated in a few sectors than in the past. So answer is three, because funds trading volume is decreased means she is hanging on to the losing stocks. So observation three is least likely. The question is least likely because it has got nothing to do with concentration, okay, but got to do with holding on to losers. Which of Jordan's actions least supports that she may be affected by illusion of control? Least supports her dismissal of Tang's analysis, her routine of holding weekly team meetings, her comment on market turnaround and current holdings. So illusion of control means she believes that she knows how to do the things and she has memorized, she knows that markets will revert. These are all illusion of control. Her routine of holding weekly team meetings is a good action that is required to take other people's views. But because of behavioral biases, she is finally going by her own call. How does Jordan most likely demonstrate loss aversion bias? How does Jordan most likely demonstrate loss aversion bias? So telling the team not to worry, answer is again C, deciding to hold the losing positions until they turn around. She doesn't want to take losses. Which of the four emotional biases has Jordan most likely exhibited? Overconfidence. So she has a lot of overconfidence. Which of the following did Jordan not demonstrate? Self-attribution, she has demonstrated. Illusion of knowledge, she has demonstrated. Illusion of control. Representativeness. Representativeness is not demonstrated. Representativeness uh, is a cognitive bias in which people tend to classify new information based on past experiences and classifications. Jordan is not letting her certainty about the future or her decision toward losing back to anything she has done experienced in the past. So that is a good one. So she didn't say that I was successful in the past, and so that is representativeness is not demonstrated. Which of Frank's findings is not a typical consequence of self-control bias? Which tanks finding not a typical cause. Failing a failure to explore other portfolio opportunities. Asset allocation imbalance problems in the portfolio, higher risk profile in the resulting from pursuit of higher returns. Yes. So again, like this is illusion of control kind of thing. So she has kept higher risk profile and the portfolio is not doing well. Asset allocation, they're too risky, IPS not revisited. Okay, failure to explore other potential opportunities. That is actually not looking for other potential opportunities. That is status quo bias. That is called status quo bias, not self-control. Okay, self-control bias occurs when individuals deviate from their long-term goals. In this case, the IPS, because of a lack of self-discipline. Okay, that is self-control, lack of self-discipline. Okay, fine. So